Welcome back, traders. If you've ever wanted to master the art of momentum trading, then today's video is tailor-made for you. We are diving deep into the relative Vigor Index, a powerhouse momentum indicator that can help you catch trends early, avoid false breakouts, and time your entries and exits like a pro. Whether you're just getting started or looking to refine your advanced strategies, by the end of this video, you'll have a complete understanding of how to use the RVI indicator in different market conditions. Ready to become an RVI expert? Let's get into it. First things first. What exactly is the relative Vigor Index? The RVI is a momentum oscillator that measures the conviction or vigor behind a price movement. Unlike many other momentum indicators that just measure price change, RVI focuses on the relationship between a period's open and close prices relative to its trading range. This makes it highly effective in confirming the strength behind a price move. John Ehlers, the creator of the RVI, is a respected figure in the trading community, known for his work on market cycles and advanced signal processing. His intention with RVI was to create a tool that cuts through market noise and provides cleaner signals in trending environments. In simple terms, when the RVI is high, it shows buyers are in control, and the market has strong upward momentum. When the RVI is low, it suggests sellers are dominating, and downward momentum is strong. The RVI's unique method of calculation gives it an edge in trending markets where momentum confirmation is crucial to entering and exiting trades profitably. Alright, let's now unpack how the RVI is actually calculated. I'll keep it simple and straightforward. Calculate the close minus open for each period. This shows how much buying or selling took place. Calculate the high minus low for each period. This gives the range of price movement. Smooth both values using a simple moving average, SMA. Typically, a 10-period SMA is used to smooth out short-term volatility. Formula for RVI matched SMA of close open, SMA of high low. The idea is to normalize the strength of the price movement against its trading range, giving you a cleaner view of the underlying momentum. Because RVI uses smoothed data, it reacts slower to sudden price spikes, reducing the number of false signals compared to faster reacting indicators like RSI or stochastic oscillators. Now, how do you actually read the RVI to make trading decisions? The RVI is plotted as two lines. The RVI line, the main indicator line. The signal line. A smoothed version of the RVI, usually a 4-period SMA key reading points. Crossovers. When the RVI crosses above the signal line, it suggests a bullish signal. Momentum is shifting upward. When the RVI crosses below the signal line, it suggests a bearish signal. Momentum is shifting downward. Zero line behavior. RVI values above zero indicate bullish momentum. RVI values below zero indicate bearish momentum. Divergences. Bullish divergence. Price makes a lower low, but RVI makes a higher low. This hints at weakening selling pressure and a potential reversal upward. Bearish divergence. Price makes a higher high, but RVI makes a lower high. This suggests buyers are losing strength and a potential reversal downward. Visuals. Animated examples of crossovers, zero-line breaks, and divergences. You might wonder, how does RVI stack up against other popular momentum indicators? RVI versus RSI RSI measures overbought and oversold conditions based on price gains and losses. RVI focuses on the open-close relationship relative to the trading range, making it better for trend confirmation. RVI versus MACD. MACD measures the difference between two moving averages capturing trend direction. RVI measures conviction behind each candle, making it quicker at spotting momentum changes. RVI versus stochastic. Oscillator. Stochastic focuses on the closing price relative to the high-low range over a period. RVI smooths this movement for a cleaner signal in trending environments. Pro tip: use RVI in trending markets and RSI in range-bound markets. Time to get practical. Let's look at actionable strategies you can use with the RVI to improve your trading results. Strategy 1. Classic RVI crossover strategy. Simple but effective. Act on RVI and signal line crossovers with optional support shear resistance confirmation. Strategy 2. RVI plus. Moving average trend filter. Trade only in the direction of the trend for better results. Strategy 3. RVI divergence strategy. Spot reversal opportunities using divergences between price and RVI. Strategy 4. Multi-time frame. RVI confirmation. Boost accuracy by confirming setups across time frames. Strategy 5. RVI plus Fibonacci retracement zones. Use RVI bullish crossovers near Fibonacci retracement levels like 50% or 61.8% for higher probability trades. Strategy 6. RVI plus volume analysis. Combine RVI crossovers with volume spikes to validate momentum shifts. Strategy 7. RVI and Bollinger Band breakouts. Look for RVI crossovers happening as price breaks above/below. Bollinger Bands for explosive moves. Your settings should match the asset and time frame you're trading. Quick recap. Forex, 10-14 period, focus on H1, H4, at stocks, 14 to 20 period, focus on D1, W1, on crypto, 8 to 12 period, focus on H4, D1, indices, 10-14 period, focus on H1, H4. Before you go live, backtesting is a must. 100+ trades minimum. Track win rate, reward, risk, drawdowns. Forward test in demo before risking real money. Many beginners misuse RVI. Here's how to avoid those mistakes. Chasing every crossover without trend confirmation. Using RVI alone without price action analysis, ignoring broader market conditions, over-optimizing RVI settings without enough sample size, forcing trades during low volatility periods. Pro tip: combine RVI with at least one other confirmation signal. Before we dive even deeper into mastering RVI, let's quickly appreciate where it comes from. John F. Ehlers, the creator of RVI, is not just any technical analyst. He's an electrical engineer who brought advanced digital signal processing techniques into trading. Ehlers believed that price movements behave similarly to cyclical signals found in engineering, meaning price action isn't random noise, it follows rhythmic patterns. The relative Vigor Index was developed as part of this thinking, aiming to smooth out random market movements while capturing real underlying momentum. In his famous books like Rocket Science for Traders and Cybernetic Analysis for Stocks and Futures, he outlines why traditional momentum indicators like RSI can produce too many false signals, leading him to create the more refined RVI. The core idea. In a healthy bull market, prices should close higher than they open most of the time, and vice versa for a bear market. Trading isn't just about numbers. It's about people, fear, greed, hope, hesitation. RVI taps into this psychology. During uptrends, buyers consistently push closing prices above opens, showing control and confidence. During downtrends, sellers consistently close lower, showing dominance. When RVI weakens despite strong price movement, it signals divergence, a warning that traders' conviction is fading. In simple words, RVI measures the energy behind price moves, not just the moves themselves. That's why it's so powerful. It looks under the surface. Want to level up even more? Here are pro tips most beginner traders don't know. 1. Prioritize crossovers. Near key levels, crossovers happening near support, resistance, Fibonacci levels, or major moving averages, like the 200 EMA, have more significance. 2. Look for multi-asset confirmation. When you see RVI confirming momentum across related assets, e.g., S&P 500 and Dow Jones moving together, the signal becomes stronger. 3. Combine RVI with volume profile. Volume profile helps you see where trading activity is concentrated. An RVI bullish crossover happening at a high volume node is extremely powerful. 4. Adjust smoothing period based on volatility. During high volatility, like news events, consider reducing the smoothing period slightly to make RVI more responsive. 5. Use RVI divergence for hidden trend continuations. Not all divergences mean reversal. Hidden divergences indicate trend continuation, a sneaky but powerful setup pros love. Even the best strategy fails without proper risk control. Here's how to protect yourself. Always use stop losses. Base stops on structure, not emotions. Example: if you buy after RVI crossover, place stop just below recent swing low. Risk only 1% per trade. If you have a $10,000 account, risk no more than 100 users on a single trade. Use position sizing, not random lots. Calculate your lot size based on stop distance and account size. Avoid overtrading RVI. Not every crossover is a trade. Wait for clean conditions. Clear trend, no major news chaos. Use break-even strategies. Move your stop to break even once the trade moves in your favor by 1R or 2R. Let's walk through real-world case studies. Case Study 1. EUR CHF USD Forex Trade H4 chart. Downtrend RVI showed a bullish crossover plus bullish divergence. Price bounced exactly from the 61.8% Fibonacci retracement zone. Result: 150 pips profit in 2 days. Case Study 2. Tesla stock trade D1 chart. Price made a new high, but RVI didn't confirm. Bearish divergence spotted, shorted Tesla with tight stop loss above recent high. 50% drop in 7 days captured. Case Study 3. Bitcoin BTC swing trade D1 chart RVI. Crossover happened while price consolidated above a major support zone. Breakout followed, leading to a 20% rally. RVI caught the early momentum beautifully. The best traders combine indicators with pure price action. Here's how. Chart patterns. Confirm breakouts from flags, triangles, and wedges with RVI crossovers. Candlestick signals. Look for RVI bullish crossovers following bullish engulfing candles. Support and resistance. RVI bullish signals near strong support zones. Powerful trades. Remember, price action leads, RVI confirms. Common myths about RVI busted. RVI is only for beginners. Wrong. Many prop firms and professional traders use momentum confirmation indicators like RVI. RVI gives late signals. False. With the right smoothing and market context, RVI can offer extremely timely entries. RVI works alone without price action. Big mistake. No indicator works alone. Always combine with market structure, SNR, and price patterns. And now, traders, you're not just familiar with RVI, you've mastered it from the ground up. From history and psychology to advanced strategies, real-world examples, and pro tips, you're ready to use the Relative Vigor Index at a whole new level. If you loved this ultimate deep dive, hit that like button, subscribe for more elite trading lessons, and drop a comment with your favorite takeaway from today's video. Stay sharp, stay strategic, and as always, happy trading.